They unleashed their most potent strategy. They deployed the heaviest weapon in their arsenal, and it misfired. For a duration of 4 decades, the silver market has existed under the looming specter of a singular, formidable acronym, the CME, the Chicago Mercantile Exchange. We have repeatedly been informed that this exchange dictates the price. We were consistently told that if the price of silver experienced an accelerated ascent, the exchange would simply alter the established protocols, escalate margin requirements, and compel speculative traders to divest their holdings. We observed this unfold in 1980 when the Hunt brothers were financially decimated by regulatory shifts. We witnessed it again in 2011 when 5 increases in margin within a 9-day span caused the price to plummet from $50 to $30. This pattern repeated in 2020. The margin adjustment is the ultimate recourse. It represents the system's declaration that the current trend has reached its conclusion. Yesterday, Monday, January 12th, the system activated its ultimate measure. They raised margins by 15%. They increased the expense of maintaining a contract by nearly $6,000. They exerted every possible effort to orchestrate a price collapse. However, today, Tuesday, January 13th, 2026, we are observing a price chart that defies all conventional financial history texts. Observe the display. The price of silver is not declining. It is not stagnant. It is currently trading at $88.95. This represents an increase of $3.78 for the day, a gain of almost 4.5% following a punitive margin adjustment. This is the unequivocal definition of a failed attempt to eliminate the upward momentum. The financial institutions attempted to extinguish the rally. They aimed to shatter the psychological resolve of prospective buyers. Their objective was for individuals to awaken this morning, confront a declining price chart, and engage in panic selling. They intended to precipitate a washout of leveraged positions. Instead, the market responded to the margin hike with disdain. This demonstrated resilience is the most robust bullish indicator we have ever encountered. When a market disregards unfavorable news, it signals a bull market. When a market ignores a direct regulatory assault, it portends a supercycle. We are presently witnessing the genesis of a truly impervious market. Adverse developments have no lasting impact. The suppression tactics that proved effective for decades are now proving ineffective against the formidable force of physical demand. To grasp the full significance of what has just transpired, we must examine the mechanics of the unsuccessful market manipulation. Yesterday, upon the dissemination of the news, we observed a temporary price dip. The price receded to $83.50. This was the algorithmic response. This was the reaction to weekend positioning. For approximately 4 hours, it appeared that the financial institutions had achieved their objective. It seemed they had successfully capped the price at $85. However, something remarkable occurred. Buyers emerged to capitalize on the lower price. Who acquires assets during a price dip when faced with a margin increase? Who positions themselves directly in the path of a regulatory onslaught? It is not the individual investor found on platforms like Reddit. The typical retail investor harbors a deep-seated apprehension of margin calls. The entity that purchased the asset at $83.50 is an entity unconcerned with margins. It is an entity that operates with readily available capital. It is an entity with the explicit intention of acquiring the physical commodity from the exchange and permanently removing it. This validates our long-held conviction that the paper market has relinquished its control. The margin adjustment only impacts traders who are leveraging borrowed funds to speculate on price movements. It has no bearing on entities like Samsung. It does not influence the Reserve Bank of India. It does not affect Chinese solar panel manufacturers. For those acquiring physical metal for industrial applications, a margin adjustment on the commodities exchange is inconsequential noise. In fact, it presents a favorable opportunity. It temporarily depresses the price, allowing for the acquisition of inventory at a discounted rate. The financial institutions have inadvertently placed silver on sale for the very entities that are depleting their reserves. They are inadvertently nourishing the very demand they sought to stifle. Observe the subsequent recovery. It was not a gradual uptrend, it was a dramatic V-shaped surge. We ascended from $83.50 to $88.95 in less than 24 hours. This constitutes a $5.50 advancement from the lowest point. This indicates that the underlying pressure is building with unprecedented intensity. Each instance of price suppression is met with a more forceful rebound. The market's volatility is increasingly skewed towards upward movement. We are now approaching the $90 threshold. $88.95 is effectively $89, and $89 is merely a rounding adjustment away from $90. $90 represents a significant historical level. It signifies an almost doubling of the price from the breakout point of $50. It is the juncture at which mainstream financial news outlets can no longer disregard the prevailing narrative. However, there is a potential pitfall, and I wish to issue a warning regarding it. When a market develops such resilience, when it effortlessly shrugs off margin, increases, and regulatory interventions, it attracts a particularly speculative form of capital. It draws in those who chase momentum. It attracts speculative capital. We are observing a resurgence in open interest. Speculators are re-entering the market, operating under the assumption that the market is invincible. This scenario positions us for heightened volatility. The financial institutions have failed in their initial attempt to depress the price via margin adjustments. Do you believe they will cease their efforts? Unlikely. They will almost certainly implement further margin increases. They might do so tomorrow. They might enact them on Friday. They could raise the requirement to 20% or 30%. They will persist with these adjustments until a critical point of failure is reached. However, the crucial distinction between 2011 and 2026 lies here. In 2011, there was an abundant supply of silver. The vaults were replete. The shortage was entirely speculative in nature. Today, the vaults are demonstrably depleted. Yesterday's data revealed a remarkable outflow of 2.2 million ounces in a single day. You can escalate margins to 100%. You can legislate against leverage futures trading. But if Samsung requires 10 million ounces of silver for battery manufacturing and only 5 million ounces are available in storage, the price is destined for astronomical levels. Margin adjustments cannot magically create more physical metal. The failed attempt to suppress the price at $83 has starkly exposed the vulnerability of the established order. It has demonstrated to the world that the perceived authority is unsubstantiated. The CME deployed its most powerful tool, and as the dust settled, the silver bull market remained standing, exhibiting greater strength and robustness than ever before. This engenders a cyclical reinforcement of sentiment. The short sellers, including the major financial institutions, are now experiencing profound apprehension. They recognize that their most formidable weapon proved ineffective. They understand their current defenselessness. This fear is precipitating a rush to cover short positions. We are observing indications that the commercial banks are beginning to capitulate. They are no longer actively attempting to halt the market's upward trajectory. Instead, they are endeavoring to extricate themselves from a precarious situation. They are repurchasing their short positions at $88, driven by the fear of having to buy them back at $188 in the ensuing week. This represents a short squeeze in its purest manifestation. It is a panicked withdrawal by the very entities that orchestrated the price suppression. Therefore, as we conclude the initial segment, the message is unequivocally clear. The established system retaliated and the system faltered. The price stands at $88.95. The upward trend is vertical and resistance has dissolved. However, if the loss of control by the financial institutions were the sole narrative, we might anticipate a price of $100 next month. Nevertheless, a secondary squeeze is unfolding concurrently. A squeeze that is fundamentally more significant and considerably more challenging to resolve. While the financial institutions are depleting their capacity to manipulate through paper instruments, the mining operations are facing shortages of the physical commodity itself. In the subsequent installment of this in-depth analysis, we will delve into the concealed data within the futures market. We will scrutinize a phenomenon known as backward rolling. While a technical term, it signifies a tangible sense of urgency. We possess evidence of traders incurring additional costs to expedite their acquisition. They are transitioning from March contracts to January contracts, driven by the awareness that waiting until March may result in the unavailability of silver. The financial institutions were unsuccessful in arresting the price's ascent. Now the mining entities are proving incapable of delivering the physical commodity. This constitutes a dual squeeze, and the situation is poised to become exceptionally acute. If the first part of this analysis focused on the superficial elements, the margin adjustments, the sensational headlines, and the price volatility, the second part will address the underlying signal. The noise is what they intend for you to observe. The signal is what they are attempting to conceal. While the mainstream media fixates on the $88 price point, questioning whether it represents a speculative bubble, the forensic accountants within the futures market are examining a set of data far more alarming than the price itself. They are scrutinizing the open interest report from the CME. Specifically, they are analyzing the behavior of traders holding contracts for delivery in March. In a typical healthy market, futures trading adheres to a predictable cadence. This is referred to as rolling forward. If you possess a contract for January delivery and have no intention of acquiring the physical metal, as is the case for speculators or financial institutions, you would sell the January contract and subsequently purchase the March contract. This effectively defers the obligation into the future, rolling the position forward. This has been the established practice for 50 years. However, on Friday, and continuing through Monday and today, Tuesday, January 13th, this established practice ceased to function. The rhythm was disrupted. We witnessed a phenomenon known as backward rolling. Examine the data we have uncovered within the intricate details of the CME report. The open interest for the March 2026 silver contract experienced a decline of 450 contracts. This is considered normal as individuals are closing out their positions. However, where did these positions migrate? Did they transition forward to May? Did they roll forward to July? No, they moved in reverse. The open interest for the January 2026 contract, the contract that effectively represents immediate delivery, increased by 135 contracts. The February contract saw an increase of 50 contracts. When conducting a net calculation, it appears that approximately 355 contracts that were comfortably situated in the March delivery window decided that March was too distant. They divested their March positions and acquired positions in January and February. Let us translate this into tangible terms. 355 contracts represent 1,775,000 ounces of silver. That is nearly 2 million ounces of silver that have effectively cut to the front of the line. Envision yourself standing in line for the latest iPhone. You possess a ticket guaranteeing you a phone in March. You are comfortably positioned towards the rear of the queue. However, you suddenly overhear a rumor. You learn that the shipment scheduled for March might be cancelled. You hear that production has ceased at the factory. What action do you take? You rush to the front of the line. You locate an individual holding a ticket for immediate availability and offer them a substantial premium to exchange positions. You move from a future delivery to an immediate one because you lack confidence in the future availability. This is precisely the scenario currently unfolding on the commodities exchange. Industrial purchasers and sophisticated wholesale traders are examining the March delivery window and perceive a significant void. They anticipate the possibility of a force majeure event. They recognize the depleted inventories that we discussed in the initial segment. Consequently, they are reacting with urgency. They are willing to incur additional fees, elevated commissions, and augmented storage expenses solely to secure possession of the warehouse receipt immediately. This act of prioritizing immediate acquisition is the ultimate indicator of a physical shortage. In a market characterized by ample supply, no one incurs additional costs to expedite delivery. Storage incurs expenses, insurance carries a cost, security necessitates expenditure. One only opts for early delivery if the risk of non-receipt of the commodity outweighs the cost of holding it. We term this the bird in the hand transaction. A bird in the hand is worth two in the bush. Or, in this instance, an ounce in the vault today is worth 10 ounces held within a futures contract for March. Furthermore, observe the delivery notices. The report indicates an additional 170 delivery notices issued for January. This signifies that 170 traders did not merely purchase the contract for speculative purposes. They elected to take physical delivery. They declared, "Furnish me with the metal." Typically, during the delivery month, open interest diminishes as traders liquidate their positions. However, in this situation, open interest is increasing even as deliveries are occurring. The bathtub is draining, yet individuals continue to enter it. This is creating a congestion within the delivery mechanism. The warehouses are endeavoring to dispatch metal, but new buyers are stepping forward, demanding immediate allocation. The backward rolling of 1.7 million ounces serves as a signal that the just-in-time supply chain has officially fractured. Trust has eroded. If you have confidence in the exchange, you roll forward. If you have confidence in the mining entities, you roll forward. If you have confidence in the system, you roll forward. Shifting backward represents an act of distrust. It is a vote of no confidence in the solvency of the exchange. This brings us to the fundamental question. Why are these sophisticated traders so apprehensive about March? What knowledge do they possess regarding the supply chain that the general public does not? They are aware that the source of the silver supply is diminishing. We are receiving reports which directly correlate with the concept of phantom supply, indicating that the mining companies themselves are encountering difficulties in fulfilling their contractual obligations. We understand that refining capacity is operating at its maximum. We are aware of labor disputes in Latin America that are jeopardizing production. However, the backward rolling phenomenon suggests something even more immediate. It implies that the readily available inventory, the metal that circulates between London and New York, has vanished. Typically, if New York experiences a shortfall, London dispatches metal. If London faces a deficit, Zurich ships metal. This is a global financial maneuver. However, at present, the available resources are exhausted. The Shanghai phenomenon, which we discussed earlier, has absorbed all readily accessible inventory into Asia. There is no supplementary supply available to be shipped to New York in March. The traders are privy to this information. They observe the shipping manifests. They see the empty storage facilities, and they comprehend that if they delay until March, they may receive a check in lieu of a physical bar. On the commodities exchange, a rule exists. If the exchange is unable to procure the necessary metal for delivery, it is permitted to engage in cash settlement. They can issue a check for the monetary value of your contract and instruct you to depart. For a pure speculator, cash settlement might represent a profit. However, for industrial entities, it constitutes a significant setback. You may have achieved your financial objective, but for an industrial user like Samsung, cash settlement is disastrous. You cannot construct a battery with a check. You cannot manufacture a solar panel with a wire transfer. Samsung requires the physical metal. Tesla requires the physical metal. Consequently, they are engaging in backward rolling. They are securing the metal before the exchange declares a cash settlement event. They are safeguarding the physical asset while it remains technically feasible to do so. This is the underlying reason for the price being $89. It is not solely driven by speculation. It represents a premium paid for certainty. When you acquire silver at $89 today, you are not merely purchasing the commodity. You are investing in the assurance of possession. You are paying to circumvent the counterparty risk associated with the futures exchange. The disparity between the paper price and the physical reality is narrowing. However, this convergence is occurring in the most extreme manner possible. The paper market is attempting to catch up to the desperation of physical buyers. Consider the leverage involved. The margin increase discussed in the first segment was designed to eliminate leverage long positions. However, the entities engaging in backward rolling are not leveraged long investors. They are fully funded purchasers. They cannot be easily dislodged. They cannot be intimidated. They are on a mission to secure critical resources. This data point, the movement of 1.7 million ounces in reverse, serves as irrefutable evidence that the squeeze is legitimate. It confirms that this upward trend is not a speculative bubble fueled by online forums. It is a bank run initiated by the largest pools of capital globally. So, where does this leave us? We are observing a market where financial institutions attempted to depress the price and failed. We are witnessing a market where physical buyers are circumventing the established order to secure delivery. Now we are confronting a market where inventory is diminishing by millions of ounces daily. This is the dual squeeze. The financial institutions are being squeezed from above by the price, rendering their short positions untenable. The mining entities are being squeezed from below by demand, unable to increase production sufficiently. Consequently, the price has no alternative but to ascend. $89 is merely the equilibrium point for today's market pressures. However, what will occur when the January contracts expire? What will transpire as we transition into February? If the backward rolling continues, and if we witness an additional 2 million ounces bypassing the queue next week, the system will grind to a halt. The warehouses will simply exhaust their supply of registered bars available for allocation. At that juncture, we will enter a state of force majeure. The exchange will declare an emergency. They will restrict trading to liquidation purposes exclusively. We have not yet reached that point, but the available data suggests we are drawing closer each day. The backward rolling represents the preliminary tremors preceding a significant seismic event. In the subsequent segment of this comprehensive analysis, we will examine the scarcity in mining output. We will elucidate why mining companies cannot simply increase production to alleviate the pressure on the commodities exchange. We will investigate the geological factors, the ore grades, and the established timelines. The financial institutions are powerless. The exchange is powerless. And as we will explore in the third part, even the mining entities are incapable of halting this progression. The silver has been depleted, and the market is finally reflecting the reality of zero availability. We have dissected the failure of financial institutions to suppress the price. We have analyzed the urgency of traders circumventing the established order within the futures market. However, to fully comprehend why the price of silver is holding at $89 and exhibiting unwavering strength, we must trace the supply chain upstream. We must proceed to the origin. We must examine the mining operations. In a standard economics textbook, a straightforward principle is articulated. High prices rectify high prices. The prevailing theory posits that when the price of a commodity surges to $89, mining entities will expedite the extraction of additional quantities from the earth. They will inundate the market with new supply, thereby causing the price to recede. This represents the natural equilibrium of supply and demand. However, within the silver market of 2026, this textbook principle is being rendered obsolete. We are experiencing an event of supply inelasticity. This signifies that irrespective of how high the price escalates, mining entities are physically incapable of augmenting production at a pace that would significantly impact the market. The reasons for this are manifold. Firstly, one must comprehend the geological context. Silver is an anomaly of nature. Unlike gold, which is extracted for its intrinsic value, over 70% of the world's silver is obtained as a secondary product. It is an incidental discovery found within mines primarily focused on lead, zinc, and copper. This is the byproduct predicament. If you operate a lead mine and the global economy is experiencing a recession, which it currently is, the demand for lead diminishes. Consequently, you curtail production, implement workforce reductions, and excavate less ore. And because you are excavating less ore, you consequently produce less silver. It is immaterial whether silver is priced at $89 or $500. If your primary commodity is lead and the price of lead is collapsing, you will not expand your mining operations solely to procure a marginal quantity of additional silver. Therefore, precisely at the moment when the global demand for silver is at its zenith, the principal driver of silver production is faltering due to a widespread industrial slowdown. The supply curve is inverted. Higher silver prices are yielding lower overall output. However, the complexity of the situation is further exacerbated. Let us consider the silver that is currently being extracted. Where is it being directed? For decades, the established flow was straightforward. A miner in Mexico would extract the silver. It would be transported to a refiner. The refiner would produce silver bars. These bars would then be dispatched to London or New York, replenishing the inventory of the commodities exchange warehouses. That established flow has now ceased. The distribution pathway has been diverted. We are receiving confirmation of substantial transactions occurring outside the standard market channels, directly at the mine site. This phenomenon is referred to as ghost supply. Imagine you are the chief executive officer of a prominent silver mining company in Peru. Typically, you would sell your concentrate to a trading house that would then place it on the commodities exchange. However, this morning, your telephone rings. It is a procurement executive from Samsung SDI, or perhaps it is a representative from a state-owned enterprise in China. They present you with an offer that is exceptionally difficult to refuse. They state, "We will procure 100% of your production for the ensuing 2 years. We will compensate you at the prevailing spot price plus a $5 premium. We will cover shipping expenses, but you must dispatch it directly to our manufacturing facility in Seoul or Shenzhen. You are prohibited from forwarding it to the commodities exchange." What course of action do you pursue? You accept the offer. It guarantees revenue. It eliminates your hedging costs. It is an unequivocally advantageous proposition. However, what are the ramifications for the global market? It engenders a clandestine inventory. The silver is indeed being mined, but it is being secreted away into private holdings before it ever enters the public marketplace. It never appears in the commodities exchange warehouse reports. It never surfaces in the vaults of London. To a trader situated in New York, it appears as though production has effectively ceased. This explains the observed depletion of inventory that we detailed in the initial segment. The registered silver within the commodities exchange warehouses is not being replenished because the newly extracted supply is being privatized. We are in essence witnessing the nationalization and corporatization of the silver supply. This leads us to the prevalent rumors of force majeure. Within the commodities sector, force majeure serves as a legal provision allowing a supplier to terminate a contract due to unforeseen and unavoidable circumstances. Typically, such a situation implies a major conflict or a severe global crisis. However, current discourse suggests that mining entities are contemplating a declaration of force majeure on their agreements with precious metal financiers. Their rationale is that they are physically incapable of fulfilling deliveries for metal that was shorted, as it has already been allocated to industrial consumers. Should this occur, and the mining operations formally cease supplying bullion banks, short sellers would face insurmountable challenges. They would be obligated to provide a commodity they cannot procure. Accessing it directly from mines would be impossible, and withdrawing it from secure storage would also be unfeasible. Their only recourse would be to acquire it from individual investors. This scenario culminates in a dual pressure situation. Financial institutions are being constrained by the recorded market valuations, while mining companies are exerting pressure by redirecting the flow of physical metal. Examining the time frame involved, the process of discovering, obtaining permits for, and constructing a new silver mine typically spans between 10 and 15 years. Even if a substantial deposit of pure silver were identified today, it would not yield any output until the year 2036. Nevertheless, data indicating backwardation suggests that the market requires silver with immediate effect during January and February. This creates a temporal disconnect. Demand is urgent, while the capacity to increase supply is a decade away. Within this 10-year interval, price adjustments must compensate for the imbalance. The price must escalate to a degree that curtails consumption, compelling individuals to forego silver jewelry purchases and even dismantle heirloom silverware. However, as previously noted, industrial demand exhibits inelasticity. Key sectors like electronics manufacturing and defense industries cannot simply halt their operations. Consequently, the price must reach an unprecedented level, forcing holders of monetary assets to divest. At a valuation of $89, are you inclined to sell? On the contrary, you're more likely to purchase. The general public is actively acquiring. This indicates that the current price point is insufficient. The scarcity stemming from mining limitations forms the foundational support for this upward market trend. While banking instability can be addressed through financial interventions and margin-related issues can be resolved by regulatory adjustments, a fundamental scarcity of a physical resource cannot be rectified by monetary expansion. This is precisely why the recent increase in margin requirements proved ineffective. The market observed the downturn in paper assets and perceived it as a superficial event, querying the availability of the physical commodity. The metal remains in the earth or is en route to international destinations. We are entering an era characterized by resource sovereignty. Consider the geopolitical landscapes of countries like Mexico and Peru. Their governments are witnessing escalating commodity prices. It is unlikely they will permit foreign entities to extract their nation's wealth at significantly discounted rates. We anticipate an increase in taxation, the implementation of export restrictions, and potential pronouncements of nationalization in the coming weeks. Each statement made by a political figure in a mining-rich jurisdiction is expected to further elevate the premium on silver by an additional $1. The dwindling supply is a tangible reality. Silver is disappearing from public view, leaving exchanges with an abundance of paper instruments that lack underlying physical backing. In the concluding segment of this comprehensive analysis, we will examine the eventual outcome. We will integrate observations regarding market resilience, the urgency indicated by backwardation, and the constraints on mining output to project price targets. A valuation of $90 appears imminent, with $100 representing the subsequent milestone. However, if mining operations are indeed operating at their maximum capacity and the supply stream is genuinely depleted, we must contemplate price levels that seem extraordinary today but will likely appear entirely logical in retrospect. We need to discuss a future where prices reach triple digits. Financial institutions have encountered difficulties, mining resources are depleted, public interest is surging, and a perfect confluence of factors has materialized. We have reached a definitive conclusion. We have deconstructed the circumstances surrounding a failed attempt to manipulate the market, where the increase in margin requirements proved as insignificant as a pebble striking an armored vehicle. We have analyzed the panic reflected in backwardation, where institutional capital is willingly paying a premium to secure priority. We have exposed the mining deficit, wherein the flow of supply has been diverted by major industrial consumers before reaching its intended markets. The evidence is compelling and irrefutable. This is not a transient market fluctuation or a temporary disruption. We are witnessing a fundamental breakdown in the established pricing mechanism that has governed the silver market for 50 years. The dual pressure is now fully operational. Financial institutions are constrained from above, while mining entities are facing pressure from below. The sole avenue for resolution lies in price adjustment. Moving forward, we must chart the prospective course. Once an asset surpasses its historical peak and enters a phase of price discovery, traditional market indicators become irrelevant. There are no established resistance levels on charts because we are charting uncharted territory. We are venturing into the unknown. Therefore, where does this trajectory ultimately lead? Will $90 represent the apex? Will $100 be the peak? To answer this, we must look beyond the dollar valuation. As established, the dollar itself is an unreliable benchmark. Measuring silver's value in dollars is akin to measuring a bridge's length with a rubber band. The stretching of the band creates an illusion of increasing length. Instead, we must focus on relative value, specifically the relationship between the two primary monetary metals, gold and silver. Consider the current price of gold, trading around $4,631. It has risen by approximately $26 today and remains strong, serving as a stabilizing force in the evolving financial landscape. Now let us examine the gold-to-silver ratio. Historically, from the Roman Empire to the foundational period of the United States, the natural proportion of gold to silver in the Earth's crust was approximately 15:1. For every 15 ounces of silver, there was roughly 1 ounce of gold. During periods of market manipulation, this ratio has significantly widened, reaching 80, 90, and even 100:1. This indicated that silver was being undervalued, perceived as a mere industrial byproduct rather than a scarce monetary asset. However, with gold currently priced at $4,631 and silver at $88.95, the ratio stands at approximately 52:1. This ratio is rapidly contracting, reverting to its historical average. If silver were to simply return to its historical monetary equilibrium of 15 to 1 relative to the current gold price, what would its valuation be? Performing the calculation. $4,631 divided by 15 equals $38 per ounce. $38 represents the fair value of silver in a market where gold is valued at $4,600. At $88, silver is not overvalued. It is on sale, trading at a 70% discount to its intrinsic monetary parity. This is often referred to as the catch-up trade. Market algorithms and central banks are aware of this. When gold becomes prohibitively expensive for the average individual, capital naturally flows into silver, recognized as the poor man's gold due to its greater upside potential. This is why the progression to $100 is not a matter of possibility, but of timing. We are currently at $88.95, effectively at $89. The $90 mark represents a psychological threshold. It might offer temporary resistance for a brief period, but given the current momentum and the backwardation phenomenon, it is likely to be surpassed. $100 is the more significant barrier. Round numbers hold considerable appeal for the general populace. Reaching the triple-digit milestone will capture global media attention. Upon crossing $100, silver will become a prominent news item, likely featured on the covers of financial publications and leading nightly news broadcasts. It will be a topic of conversation among everyone, from your taxi driver to your grandmother. That juncture, when widespread public enthusiasm truly ignites, will represent both a period of maximum risk and maximum opportunity. It will be the moment when a genuine shortage escalates into a speculative bubble. While bubbles can be profitable, they are inherently unstable. Therefore, let us address the exit strategy. Many of you, observing your account statements today, are experiencing elation. Having acquired silver at $25 or $30, you are currently realizing gains of 200 or 300%. The temptation to liquidate your holdings will be immense. You might envision paying off your mortgage, purchasing a new vehicle, or embarking on a vacation. However, extreme caution is paramount. If you exchange your silver for dollars, what are you truly doing? You are trading a tangible asset that is appreciating in value for a fiat currency that is depreciating. You are exchanging the solution for the problem. The dollar is not the ultimate objective. It is a casualty of the current economic environment. We are in the midst of a global currency recalibration. The increases in margin requirements, the backwardation, and the mining constraints are all symptomatic of a currency losing its privileged status. Throughout history, every currency collapse from Weimar Germany to Zimbabwe and Venezuela has seen those who divested their gold and silver prematurely regret their decisions. They exchanged their precious metals for millions in paper currency, only to discover months later that a loaf of bread costs billions in that same currency. Therefore, when should you sell? You should sell when you can exchange your ounces for other income-generating tangible assets. This is the ounces to acres strategy. Do not trade your silver for paper currency. Exchange it for land. Acquire a rental property. Invest in a business that generates consistent cash flow. Allocate it to energy infrastructure. Await the moment when the speculative fervor is so intense that real estate values have plummeted relative to silver. Currently, it might require 5,000 ounces of silver to purchase a decent home. At the zenith of such a speculative period, that ratio could diminish to 500 ounces. This represents the optimal trade. You are essentially transferring wealth from one generational store of value to another, entirely circumventing fiat currency. However, we have not yet reached that point. We are at $89, just departing the launch pad. The ratio remains 52 to 1. Our objective is to witness it decline to 30 to 1 or 20 to 1. The approaching week is poised to be the most prolonged of your financial journey. The market's volatility will be unsettling. Financial institutions are not conceding defeat. They will attempt further interventions. They might raise margin requirements to 20% or even 30%. They might restrict trading solely to liquidations, reminiscent of the Hunt brothers' experience. They will endeavor to alter the rules once more, but recall the lesson from today's events. The 15% margin hike proved ineffectual. It failed because physical buyers disregarded it. If margin requirements are increased again, the outcome will likely be similar. A brief dip followed by a robust rebound. Why? Because you cannot issue a margin call against a shortage. You cannot regulate a fundamental deficit in a physical resource. The only viable method to halt the price increase is to discover additional silver. And as we demonstrated in the third segment, there is no more readily available silver. The mines are operating at capacity and existing inventories have been diverted. Consequently, the price must escalate. It must climb to a point where it effectively eradicates demand. It must reach a level where companies like Samsung declare their inability to produce batteries or where the solar energy industry faces collapse. At $89, demand is not being curtailed, it is accelerating. Therefore, the price remains too low. The dual squeeze is a historically significant event marking the convergence of the financial economy with the physical economy. You, the individual investor, stand amidst the aftermath, holding the sole asset that has endured. Do not permit them to dislodge you from your position. Maintain your holdings, safeguard your assets, educate your family. This endeavor transcends mere wealth accumulation. It is about navigating a critical transition and ensuring your place in the emerging financial order. The banks have faltered. The mines are depleted. The public is awakening. The trend is favorable, and the trend is vertical. Welcome to the era of genuine monetary value. Subscribe.